Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to calculating cost of goods sold using both a first in, first out and last in, first out, otherwise known as FIFO and LIFO method, comparing and contrasting FIFO and LIFO. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are under the 423, the calculate cost of goods sold using the first in, first out, last in, first out, FIFO and LIFO tab under the practice problems section. Closing this back out, we're going to have our information up top. We'll read through the information and then we'll apply that information to working the practice problems. Quick recap on first in, first out, last in, first out. Remember that these are flow assumptions. So then what is a flow assumption? Why do we need a flow assumption? So note, if we're selling inventory, if the thing we're doing to make money is actually the sale of inventory as opposed to a service item, then we may need to have an assumption as to the physical flow of the inventory, an assumed flow of inventory. Now, when would we have that versus actually specifically identifying the inventory units that we are selling? Note that if we have units that are all the same and usually relatively cheaper in unit price, as opposed to things that are going to be different, possibly because we are doing custom units of some kind, then we're going to use these flow assumptions possibly. In other words, if you're doing inventory units and you basically get a custom order for somebody and you're making inventory that's all going to be different, then the cost of the inventory will likely be higher due to the fact of that customization. And when you give the inventory to someone due to them being different in nature, you will have to identify the actual inventory unit that you are then selling. As opposed to if you're making a whole bunch of units that are all basically the same, then when you sell them, it may not be worth your time to actually track the physical unit that is applying to the item that is actually being sold. In other words, you don't know which unit's being sold. Is it the first one you made? Is it the last one you made? Now, normally, in terms of just an inventory flow that you would like to have as a desired flow, you would think it would be a first in, first out method, meaning you would like, as if you stock shelves, to try to get people to purchase the later one, the older one, the one that you made first. The oldest unit of inventory is the one you would like to sell first, and then sell the later ones later so that you're always kind of rotating through the inventory. And that would be similar to the assumption of a first in, first out method. But realize that although that's closer to what we would like to be physically taking place in the real world, it is still simply an assumption. The opposite to that assumption would be last in, first out, meaning we're assuming that the last unit that we produced is the one we sold. Now, why would we make that assumption? It's not what we would like to see happen in the actual real world most of the time. We would probably make that assumption mainly because of the effect that it will have on the financial statements. In other words, in a period of rising prices, last in, first out will actually typically make us look worse, meaning our net income will typically be lower. And why would we want net income to be lower? Well, for taxes, maybe. It might lower taxes. So one of the reasons you might see LIFO assumption could be because people are looking to have a lower income in order to basically lower the taxes, possibly. That's one reason you might have it. But it's a really good example, these two methods, FIFO and LIFO, to see how the assumption that we're being made, because we don't know which units we are selling, will have an impact on the financial statements. And we want to understand the impact on the financial statements and basically be able to intuit what the impact will be. Now, I would go with the general assumption that basically there's going to be rising prices over time. And that's going to be one of the problems that we're going to have, even though we're selling the same units, whether we actually purchase them, mark them up, and sell them as we would for a retail store, or whether we actually produce them. Usually the price of the units will go up, meaning it's going to cost us more to buy the inventory or to make the inventory due to, if all else is equal, inflation, meaning value of the dollar will typically go down because really the Federal Reserve, when printing dollars are basically is shooting for a 3% inflation. So that's kind of what, so you would expect then the prices of things to basically rise over time, all else equal under normal conditions. Not always the case, because obviously if you're in a specific area and say you have some kind of food product or something in what you're making in the farm and you had a good year of farming, maybe the cost of whatever you're putting in there could decrease. So it could be quite the case that it costs less to produce certain things. But you want to think about it as the normal condition as prices going up, because under the normal conditions, then you could think that LIFO or FIFO will typically make you look better, and LIFO will typically make you look worse, and then you can flip your assumptions when the opposite is happening under unusual conditions, or the opposite conditions then would be normal, that being prices increasing under normal conditions, therefore decreasing under the abnormal conditions. So that's what you want to keep in your mind. We'll see that as it plays out. Also note that the other flow assumption you could use, or an estimating method, would be an average method, which would kind of fall in between these two. So as we do this, you want to understand how this would practice, you would do it in practice, and also what the effect on the financial statements would be as we think about different assumptions, different estimates that we are having. So we have the beginning inventory in units is going to be 780. The cost per unit of those beginning inventory units is $10. Then the units produced in the current year or month, and note this would work whether we're producing the units or whether we're simply buying inventory, marking it up, and selling it. Whether we have a retail or manufacturing company, we could still use a FIFO or LIFO method. So then we have the 12 units. They've gone up in price. Remember, that doesn't mean the price that we're selling the units for. We have some control over that. These are the cost of the material inputs or the cost of the inventory units themselves. If it were a retail company, we don't have much control over that. It is what it is. Then we have the units sold during the month are going to be the 1,800. Calculate cost of goods sold using both first in, first out, last in, first out, FIFO and LIFO. This is just a recap of the information we just saw in a bit more summarized format, so we can then go through our calculation. When you go through these calculations, you want to basically set them up in this format, whether you're looking at it in practice or in a book problem. If you're thinking about the idea of you have to do these in a test situation, realize that the test could ask you for basically the cost of goods sold bottom line number, or they could ask you for ending inventory. You don't want to start memorizing different ways to set up the problem if they ask you similar components of a first in, first out, or last in, first out problem. You want to memorize how to set up a standard format so that you can answer any question that is given. So I would write out the entire thing like this until you understand it well enough that you can shorten that down into a shortened worksheet if they ask you just one side of the question or another side, meaning if they ask you for cost of goods sold only or ending inventory only. So this worksheet would look like this. We're going to have the description over here. We're going to have 3 sections. It looks pretty intimidating to set up, but just remember that the 3 components in each of the 3 sections will be the same, meaning we'll have the units, we'll have the unit cost, and then the total. Unit cost, total. Unit cost, total. The first column is going to represent the production, what we're making, and the beginning inventory in our case. The second column is going to represent those units that we sold, which means I'm going to put sales here, the ones we sold, but we're concentrating not on the sales price, but the cost of goods sold, the cost of the items. And then the last one is going to represent the ending inventories, those we haven't sold, those still on the balance sheet. All right, so we got the first in, first out. This is probably the method, most commonly used here. Beginning inventory in units, we said was 780. We got 780 units. They cost $10. That's going to give us a total of 780 times 10, or dollar amount 7,800. Remember, when we think about the financial statements, we're valuing things in dollars. So obviously we can't put on the financial statements we have 780 units. We have to say we have $7,800 worth of inventory. So then we're going to say that we had what we produced in the current month. We produced another 1,200 units. It would be similar if we just basically purchased the material or the inventory that we would then sell in like a retail versus manufacturing type of company. They cost now $12, and $12 times 1,200 is going to give us that 14,400. So notice they have increased in price now. So that's going to give us ending units. We've got ending units of 1,980. They're all the same units, but the price of those units are different. So, and that gives us the total of the 22,200. This is the amount of inventory in dollars that we had available to sell for the month. This is the number of units we had that we could sell, and they have differing costs in these different 2 groups depending on when we purchased or made the inventory. So now let's consider the cost of goods sold. Now, these are the units that we sold. So we're thinking, okay, these are the units we sold. But remember, there's two prices you deal with when you sell goods. One, the sales price, what we determine we're going to sell them for. Two, cost, the cost, what we purchased them for. We have nothing to do with the sales price right now. That's something that is different. We may base it on the cost, of course, but there's different methods for us to do that. When we're focusing in on the cost and the flow of the cost, we're keeping the sales price completely separate. So although I'm saying we sold these units, we're concentrating on the cost of the units that we sold, not the sales price. So we're going to say that if we sold the units, then we got to think about, okay, which ones did we sell? We sold 1,800 units. Which ones did we sell? So to calculate cost of goods sold, we're gonna be thinking about we sold the old ones first. We're gonna assume that we sold these 780 units, even though they're all the same, at the older price, the $10. Now remember that in a period of rising prices, we would expect that the older units, the ones we've produced before, would be cheaper than the newer units. Therefore, even though they're all the same in nature of what they are, so if we assume that we sold the older units first, we're gonna typically end up with a cost of goods sold that will be less than if we assumed we sold the more expensive ones or the later ones produced. Cost of goods sold is an expense, so that's going to make net income be higher. So this will actually make us look kind of better than we would if we used like a LIFO method. So we're gonna wipe out then the 780 at the $10. So 780 units at $10. We sold all of those, and then we had another 1,020 that we needed in order to get to that 18,000 that we produced, or in other words, we produced 1,800 minus the last row 780 means we cut into the 1,200 by 1,020 amount, and that's what we needed in order to get to the total 1,800. Those cost $12. So $12 times the 1,200 gives us the 12,240. 12,240 plus the 7,800, that gives us the cost of goods sold of 20,040. So note, if they just ask for cost of goods sold, you could stop there, right? That would be it. And you can kind of figure that by just looking at this beginning worksheet. You can say, okay, which ones did they sell first, and basically work this out. But they could ask you for the ending inventory, how much is left. So if how much is left, you can say, okay, well, this row was completely wiped out. This 780 at $10 minus the 780 at $10 means there's zero left at $10. 10 times 0 is 0. Of this row, we had 1,200 at $12. We sold 1,020 of them. 1,200 minus the 1,020 means we have 180 of them left at the $12. That's going to give us the 2,180. So that means that we have a total then of the 2,180 that is left in the ending inventory after this process. Now again, once you get good at this, if they just ask you for ending inventory, you can kind of mark out this information here and just say, okay, well, the ones that are left, that means that we had total units of 1980 minus 1800. That means we got 180 left, and those must all be still of the older, of the newest units that are still left in ending inventory times 12, and that'll give us your 2,160. But again, until you can get good at this, I would make the whole worksheet. And even when you are good at it, it's useful to make the whole worksheet because they can make this more complex. The more layers that you have, the more complex it is. It's worthwhile to just understand how to set this up even by hand or in Excel if you need to, and set the whole problem up if you have a more complex problem or even for simpler ones. So let's do the same thing. We're going to do LIFO now. Here's our data. We've got the beginning inventory 780, the cost per unit 10, the unit produced in the current month 1,200, the cost per unit then is 12 of those units. So once again, we have this rising prices. Units sold during the month at 1,800. Now we're using last in, first out. We're going to assume that we sell the later units that we produced. So last in, first out, we're going to take the beginning inventory. It's going to be that 780 at the $10, the cheaper price. That's going to be the 7,800. Then we produced, same thing, same process. The current month, we produced 1,200 at $12 to give us then another 14,400. Now we have, at the end of the day, we've got the total inventory of 1,980 units, but they had two different costs to them. And that gives us total dollar amount of the 22,200 we had available to sell during the period, meaning this many units, this many dollars worth of units between these two layers. Now, when we sell them, we're going to assume we sold the later ones, which in a period of rising prices would be the more expensive ones. So when we go to the sales item, we're selling them, but we're tracking the cost of the items we sell, not the sales price. We're going to assume then that we sold the 1,200 first. So I'm moving to the latest column first, saying, okay, first we sold the 1,200 at the $12 to, let's just reveal the whole thing here. The 1,200 at the $12 to give us the 14,400. And then I got to back into the prior column, meaning once we have that, we're going to then say, okay, so we sold 1,800 minus the 1,200. That means we have to cut into the prior row, the prior level at 600. So of the 780, we sold 600 of them. So you have to think about this going from bottom to top instead of top to bottom. We start at the last layer. We sell them first, which are typically the more expensive ones. That will result in cost of goods sold being higher than under first in, first out, meaning net income will be lower, making us look worse in essence. And then we cut into the prior units. Now note that if you keep on buying more units, then you could end up with these layers that are very old under a first in, first out method. They're never going to get sold, which is weird. I mean, that's not what you would want under a flow method, but that's just how it works if you use this assumption method, and we don't know which units we sold, so therefore you would think that you can use either method would be reasonable considering that. So that means what are we going to have left? Well, let's take the middle column again first. The last column, the 1,200, at $12 we sold all of them, meaning 1,200 minus 1,200, we assume that we sold of the more expensive, later produced $12 units, bringing them down to 0 times 12 is 0. And of the ones that were the 780, the older and cheaper ones, we sold 600, therefore 780 minus the 600 is 180 times the $10 gives us the 1,080. So 1,080 is what we have left in ending inventory. And once again, note that the ending inventory also makes us look worse under LIFO under rising prices, meaning if we assume we sold the later, more expensive units, then that means what's left in ending inventory, the earlier or cheaper units. And note that's an asset. So our assets are lower than they would be under first in, first out. Cost of goods sold is higher, which brings net income down. And so therefore, once again, under a period of rising prices, as we see here, 10 to 12, the price of the cost of the things that we are producing, LIFO will typically make us look worse because it makes our net income look worse on the income statement because cost of goods sold is higher and it's an expense. So net income goes down. And then on the balance sheet, it makes us look worse because the assets are going to be lower than they otherwise would be. Now, then if you get that in your mind, you can just simply reverse that in a period of a more unusual period, the non-norm, which would be that the cost goes down, which can happen. It's not, I mean, it happens depending on what industry you're in and what you're purchasing. So then once you get the norm down, you flip that. So if this was a period of decreasing price for the cost of the good of what we're purchasing, the inventory, then that would make us look better. LIFO would make us look better in that event, meaning the net income would be higher and the ending inventory would be higher as well. The net income would be higher, the ending inventory would be higher, the cost of goods sold would be lower, which would be what would result in the net income being higher. So if you take a look at these two tables and just kind of compare them out, you can see that we have the cost of goods sold here at the 20,040 versus the 20,400. So 20,040 versus the 20,400. That means that the cost of goods sold is less for FIFO, more for LIFO, and that means the cost of goods sold being higher under LIFO will make us look worse, right? Because that'll make the net income lower. And then if you look at ending inventory, we have the 2,160 on assets. We would like to look good, our assets would be higher, right? Assets at 2,160 under first in, first out. Last in, first out, we're at the 1,800, so they're lower here. So we're looking worse under these conditions, under the rising prices, under the last in, first out. When would you want to look worse? For taxes, possibly. It might be a benefit. That's when it would be a benefit to look worse, typically, because if your net income is lower, if your taxable income is lower, then you may have a lower income tax.